In this video, we'll be talking about the capital gains reserve, and we'll look at an example. Let's take a look at the case facts. Several years ago, a taxpayer acquired a building for their unincorporated business for a total of $1.2 million. The estimated fair market value of the land that the building was situated upon was $250,000. The building was then sold on January 1st, 20x7. The property was sold for $1.5 million. The land was estimated to be $300,000 of that total. The UCC balance in the Class 1 was $790,742. The building was the only asset in this class. The terms of the agreement. The purchase terms are as follows. The buyer was to make a 10% down payment at the time of purchase, so that would be $150,000 if we take $1.5 million and multiply it by 10%. The remainder is payable on January 1st of 20x9, a few years later. There is an annual interest rate of 6% payable on December 31st, but no payments are required in 20x7. That means the principal amount owing, the $1.35 million that's left owing after the down payment, is left owing until the payment date on January 1st, 20x9. Now, this is a situation where a taxpayer is going to have a significant capital gain, but they aren't getting all of the cash for this capital gain until a few years later. This raises a question for the taxpayer. The question being, how can this taxpayer use the capital gains reserve, really to improve their overall tax situation and cash flow situation? So before we get to the answer, I'd like you to take a moment to recall from lecture some key provisions, specifically provisions in ITA 40 subsection 1 paragraph A. Subparagraph 1, we looked at all the way in the beginning of our course. It talks about how a capital gain is equal to the proceeds of disposition, subtract the adjusted cost base, and any selling costs. Subparagraph 2 deals with the fact that we need to add back any capital gains reserves that were deducted in a prior year. They need to be added back in this year. And then subparagraph 3 is where you will find the calculation for the capital gains reserve. Once again, here are all of the case facts. If you haven't attempted this question already, this is a great time to pause the video and try the question. If you're ready now to take a look at the debrief, let's get to it. And we begin with capital gain and recapture. Let's just take a look at everything from a big picture perspective. We know that there's a capital gain on this transaction, and if we want, we can break it down by the asset type. There was land and a building. We have our proceeds of disposition, $300,000 for the land and $1.2 million on the building. And from that, we subtract the adjusted cost base, or our capital cost, of $250,000 and $950,000. Our capital gain then is $300,000. And what you would typically do is you would multiply this by a half. You'd have a taxable capital gain of $150,000. We'll see that in this situation, because all of the cash is not received until, sometime later, we are eligible to use the capital gains reserve. Before we move on to that part of it, of the solution, let's not forget that there is a subdivision B consequence here as well. So if we look at subdivision B, we have a building. The land doesn't matter for this portion. And that building is in its own CCA class that has an opening UCC balance of class 1 at $790,742. We know when there's a disposition, we take the lesser of the proceeds of disposition, in this case that's $1.2 million, and the capital cost, which is $950,000. This results in a negative ending balance in the class, which we can't have. We call that recapture, and we bring that into income. What we aren't going to bring into income is the $150,000 taxable capital gain, and that's because we're going to use something called the capital gains reserve. Now notice my wording, I'm saying it's the capital gains reserve. That's because instead of focusing on the $150,000 and applying the reserve to the taxable capital gain, we actually focus over here on the $300,000. And the capital gains reserve is meant to spread us out on that portion there, is what we're going to spread out. We'll multiply that by the inclusion rate, and then we'll end up with a smaller taxable capital gain in each year. Let me show you what I mean. In 20x7, we will have a taxable capital gain, recapture, and some interest. Remember, with a down payment of $150,000, we would calculate the reserve to be the lesser of two things. The first item that we would calculate is as follows. We'll take 300,000 multiplied by 1.35 million. 1.35 million, I'll explain in a second, divided by 150 equals 270,000. This calculation is essentially taking the capital gain, multiplying it by the proceeds that are not yet due, and dividing it by the total proceeds. We compare that to another calculation, where once again we take the capital gain, this time we multiply it by 20%, and you'll see I've got that multiplied by 4 minus 0, and that will equal 240,000. So 240,000 is the lesser of these two amounts. But what did I just calculate? Well, I took the capital gain, multiplied it by 20%, which is hard-coded in the Tax Act, and then we took 4, which is also hard-coded in the Income Tax Act, and we subtracted 0. That 0 represents the number of preceding years that have ended after the disposition. Because this is the year of disposition, no tax years have ended prior to this. We can now take the lesser of those two amounts, the 240,000, and apply that as a reserve to our total capital gain in order to calculate our taxable capital gain. Recall that our capital gain was 300,000. Subtract the reserve, multiply it by a half, and we get our taxable capital gain of 30,000. Earlier, we also calculated recapture to be 159,258. That needs to be brought into income. And remember, 150,000 was paid. That means the proceeds that aren't due yet but are still outstanding is 1,350,000. If we apply the annual interest rate of 6%, there's going to be interest income of $81,000. So we get a total for 20x7 of $270,258. We can now move on to the next year. And in 20x8, we're going to have a taxable capital gain, a reserve, and interest. So for this year, the reserve would now be the lesser of. You'll see a similar calculation where we take 300,000, multiply it by the proceeds not yet due, because remember the 1.35 million isn't due until the first of 20x9. And then we divide that by the total proceeds of $1.5 million. So we get 270,000 again. We also compare that once again to 300,000 times 20% times 4 minus the taxation years that have ended after the disposition of the property. Last year has ended, so 1 year has ended. If we do the math, we get 180,000. This year's reserve will be 180,000. And don't forget, when we do the calculation, we need to add back the prior year's reserve. Based on this, the total inclusion in net income for tax purposes would be as follows. We'll take the 20x7 reserve and we'll add it back. We'll subtract the 20x8 reserve. This leaves $60,000 in net capital gain. We multiply that by the inclusion rate, and we're going to get a net taxable capital gain of $30,000. We also still have $1,350,000 that hasn't been paid yet. At an annual rate of interest of 6%, that's going to be $81,000, or the same as last year. The total for 20x8 then is $111,000. Let's move on to 20x9. And in 20x9, we're going to have a taxable capital gain and a reserve. And for this year, the reserve would be the lesser of. You're starting to get the hang of this, right? We take 300,000, we multiply it by the amount that isn't due yet, And remember, in 20x9, the full amount is paid. So the amount that is not yet due is 0. Everything is due. Divide that by the total proceeds. 0 divided by anything makes it 0. So this whole equation then becomes nil or 0. We compare that to 300,000 times 20% times 4 minus the tax years that have ended after the year of disposition, and we've now had 2 such years, and that's 120,000. We can clearly see that nil or 0 is the lesser of those two amounts. So based on this, the total inclusion in net income for tax purposes for 20x9 is as follows. We add back the prior year reserve. This year's reserve is 0, which means we have a capital gain of 180,000 remaining to deal with. If we multiply that by the inclusion rate of 1/2, we get our taxable capital gain that's included in this year's 90,000. The entire amount was paid, presumably, at the very beginning of the year on the due date, which means there's no interest. So the total for 20x9 is $90,000. Before we conclude, I'd like to quickly summarize. And I want us to observe that the entire capital gain is recognized over time as taxable capital gains. And here's what I mean. Recall that the original capital gain was 1.5 million, subtract 1.2 million, or $300,000. If we were to take that and apply the inclusion rate, we get a taxable capital gain of $150,000. Recall from the work we just did that in 20x7, we recognized a taxable capital gain of 30,000. In 20x8, we recognized a taxable capital gain of 30,000. And in 20x9, we recognized 90,000. For a total taxable capital gain realized over that period of time of 150,000. I realize that example was a bit repetitive, but I hope it got you used to the lesser of calculation that we look at when dealing with capital gains reserves, and helped you understand how in the following year you need to add back the prior year's reserve. As always, everyone, thank you so much for watching.